Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Well, welcome, Art Jarvis. What is it? Taking Stock episode
34.
34. See, now you're on it.
I
don't even have to say the number.
Yeah.
You got it.
Yeah, don't ask me how I know that, but I do.
Well, taking stock and tracking taking stock.
Yeah.
So episode 34 on this Tuesday, the 17th, if I got my dates correct, of September. So, a lot has happened in the last 2 weeks, including, your exercise regimen beating you up a little bit, but we won't go into that unless you want to.
No, let's not.
We can skip that. But hey, the good news is, for those who care about such things, the exercise regimen continues.
It does continue.
And overall is a good thing. Right?
I'm trying. Yeah.
So when I say, how are you doing, you say...
Fantastic.
See?
Yeah, there you go.
That's because of the exercise regimen.
Is that what it is?
Sure.
I'm always fantastic. Come on.
Well, all kidding aside, welcome back for episode 34. And just before we began this recording, you said a lot to talk about, a lot of exciting things. So let's get into it.
This is going to be a lot for a 30-minute episode. So
all right, let's go.
But I think there's a lot going to happen. So tomorrow, let's start with tomorrow.
All right.
Tomorrow we've been in a rising interest rate to steady interest rate environment since March or April of 2022. We started fighting inflation, so we started raising rates. We raised rates, about a dozen times. We went from basically 0.5% to 5.5%.
Right. So
there's substantial increases. We've talked about this before. They started too late, and we still ended up with 9 or 10% inflation. But the interesting thing tomorrow, it's almost a foregone conclusion that we are going to get our first rate decrease in several years. So
since approximately March of 2020.
I mean, that was the first rate. You're right, the first raise. So so at least for 2.5 years or whatever. Yeah. But I say foregone conclusion. It's pretty much a 1/4 point decrease in rates tomorrow is pretty much priced into the market. Whether you're looking at the bond market or the equity markets, it's 99.9% assured that we're going to get this rate decrease.
Like the old ivory soap.
99.9, yeah, and we'll see if this rate increase or decrease floats. See what I did there?
Well done. Well done.
But
if it's only 99.9, it may not float. But if it's 99.99%, that sucker's going to float.
There you go. So the interesting thing tomorrow is going to be, so when we talked 2 weeks ago, there was about a 1/3 of a chance that they were talking about actually doing a 0.5 point decrease. I'm not a fan of that, but it's interesting that now here we are 2 weeks later. Now there's about a 50-50 chance that we might see a 0.5 point decrease because there's becoming more and more feeling out there that the Fed's waited too long to start decreasing rates, and maybe the economy has suffered a little bit because of that.
Well, let's throw a question into this.
All right.
So you and I have talked. Aside from here, on the show, I kind of know how you feel about going to the 0.5%.
Yep.
As opposed to just the 1/4%. Yeah. And for the listeners, you can officially say you think they should go with the 1/4%.
Definitely. I just don't see it in the numbers that we need to do a 0.5 point.
Yeah. Well, so then here's the question. When I said let's throw a question into this rate decrease, why not a 0.5%? What do you feel? Why do you feel that a quarter's good? Don't need to go a 0.5%.
I mean, first thing, what the Fed is trying to do is they're trying to negotiate what's called a soft landing. Okay, right. So they raise rates, trying to get things to calm down, try to get the economy to slow down a little bit, try to beat inflation down. But what they want to do, they want to accomplish that mission, but they don't want it to come crashing down and, we got lower inflation, but the economy's goes into that R word, the recession, right?
Yeah.
Which, by the way, here we are 2.5 years later, and we still haven't had a recession. Okay, but so that's they're trying to negotiate that, but at the same time, my opinion is they need to just start to tap on the accelerator a little bit. They don't need to push hard on it because we need to see what the result is, and I think we need more information. If they start pushing too hard on the gas pedal and we heat things up, I mean, we're still running at an economy that's running at, 2.8? No, actually 3.2 now. 3.2 year-over-year gross domestic product increase, right? So that's a good number, right? I just don't think that based on the numbers we're looking at, they need to press harder on the accelerator than more than a quarter point. So I think, the thing is, a quarter this way, a quarter that way, how much damage is that going to cause? Nothing substantial.
Well, that's the question.
Right.
At the end of the day, that's the question. That, and that's where I was headed with that question is, what harm comes if they actually just drop the, drop the rate 0.5% right now as opposed to the 0.25%. You don't feel like it's not going to cause serious damage.
I don't think it's needed, but I also don't think it's going to be cause major damage either. Now, if they do 0.5 point, another 0.5 point, they really start pushing on the accelerator, I really become concerned. But here's the interesting part. We'll talk about the psychology of the market. So, but 3 scenarios. They don't lower rates tomorrow, and the market loses its mind, right? I mean, the market has already priced it will be ugly, the stock market will go down substantially, and things like that. I think the percentage probability of that happening is almost 0. Then you got a 0.25 point. Well, that's what's pretty much expected, But so let's say they do a 0.25 point. Now you got 50% of the people that aren't happy because they didn't do 0.5 point. So it's kind of that, buy the rumor and sell the news. So if we get a 0.25 point decrease tomorrow, we got what we expected. You didn't do me any favors. You didn't do anything unexpected. Well, then you probably still get a market sell-off, especially since we've had such a strong market here over the last couple of weeks or so. The positive thing, the third option, is we get a 0.5% decrease, and it's actually more of a positive surprise, and then that really gives the market a nice little kick in the pants. So,
well, just for some facts, I used to be able to speak.
Yeah,
clearly,
sorry.
just to get to some facts. So this news is going to break tomorrow.
Mm-hmm. Around 2:00.
All right. So, you and I have already talked about this. We talked about recording this show tomorrow, so that we could have waited. Yeah. But we're going ahead. It's Tuesday, like always. And hopefully, people will be listening to this by the end of this day, Tuesday. However, the news is going to break tomorrow. Chuck is going to check in with Art Jarvis tomorrow, or maybe Art will beat me to the punch and send me information before I even check in with you. But
I'll just call you at 2:00 and we'll watch it together. How's that sound?
That's a possibility. Yeah, well, that's all right. We could do that. But anyway, the bottom line is, and then we'll share some special edition with the folks. So with our beloved listeners.
Yeah, exactly. Yeah.
Every single one of them.
Yeah, all of it. That's right.
However many there are out there.
That's right.
We're making a lot of impressions.
Yes. Well, that's good.
That's good.
Are we making good impressions? That's the question.
Well, I couldn't say that. That's for the listeners to decide. Anyway, so tomorrow we'll get back on what happened.
Yeah.
We'll break the news.
Correct.
When it comes.
Yeah.
And then somebody will sell the news or buy the news or whatever happens then.
Well, I think there's if we don't get 0.5 point, I got a feeling the market will sell off tomorrow. So, because we come a long way. We're literally, as we sit here today, we are right up next to the market high, record high. We're at 56.63 or something like that right now, and the market high is 56.69. So that's how close we are to a record high. So we've come a long way. And last week was the best week in the markets, the equity markets, in 2024.
Yeah.
So we've come a long way, especially since whatever that was 5 or 6 weeks ago when the market lost its mind. But
if the sell-off occurs tomorrow, then what?
then we begin the great debate of when are we going to get our next our interest rate decrease. That's what's going to happen. I mean, and here's the thing: we've had good, better than expected inflation numbers. The employment numbers have turned around. I mean, they're still good. They've always been good numbers, but even the last couple of numbers have been good. We just got retail sales today. They were looking for a 0.2% decline. We actually got a 0.1% increase month over month. So, so retail sales, and that tells me the consumer's still in it to win it. And so we have good economic. We continue to have good economic numbers. We continue to have good economic trends. Okay. The problem with this market here over the last several weeks is we're what I would call directionless.
That's correct.
Now neither one of us can talk. So
without direction.
Yeah, without direction, that would have been easier. But because we've really been stuck. I mean, we kind of run up and then we run back down, we run back up, but we really haven't gone anywhere in quite some time. Yes,
looking for all those words: aimless, without direction, directionless.
It's usually a good policy for me.
Let's get really fancy and say it's been kind of meandering.
Meandering is good. Yeah, that's a good way of putting it. Meandering, I can say that too. But we've and I've said this before here in the last couple episodes or so. There's not a great reason for the market to go up 10 to 20% today or anytime soon, but there's not a great reason for it to go down 10% either. We just kind of. And the problem is, if there's not a great reason for us to go up, then we're going to go down, right? And then that's kind of what we've been doing. And just one little news story that's not as good as we wanted it to be sends the market down 8%, right? So, but then here we are 4 weeks later, up against new highs again. So, and here's an interesting thing I was looking at. So, historically, when the Fed starts to lower rates,
right.
And I'm trying to make this quick. If we are in a recession and they start to lower rates, typically the next 12 months the U.S. stock market is up 11% on average.
Wow.
If we start lowering rates and we're not in a recession, the next 12 months the market's up 23% on average. So, if we get lower rates, that makes the market multiple, potential market multiple higher, and we can get some more corporate earnings, lower interest rates. Maybe there is some potential for, 10 to 20% increase in the next 12 months. Yeah. So, but. Again, we got 12 months to debate it. But
I almost said, and then nobody will be complaining. But yes, they will.
Oh yes, that's the given. So,
it doesn't matter. Not enough.
The problem is we don't.
How much did your team win by?
Right. Yeah. And now it's always, what have you done for me lately? Right. That's honestly the thing. It's like
that's good last 2 weeks. How about today?
Yeah, I don't care what you did for me last 2 weeks. What are you going to do for me the next 2 weeks? Right. And that's the crazy thing. Like, you get a good economics report, you get a good corporate earnings report, but it comes in as expected, and nobody well, that's great. All you did was do what you said you were going to do. Right. What have you done for me lately? I want to be. I think we talked about this last episode.
We did.
I want to be surprised. Surprise me, right? And
how can you be surprised?
Well, again,
in the economic world today, I mean, the scary thing is the answer to that question is probably with a sudden drop that hurts.
Right.
That would be a bad surprise.
Sure.
I don't think we would see that coming.
Right. And that's the thing. It's the thing that you don't see coming. If you're looking for 2.8% growth, domestic product growth, and it comes in at 0, that's a bad surprise, right? But if you're looking for 1.1% increase gross domestic, and it comes in at 2.8, you're really happy. That's a pleasant surprise. Right. And some of these numbers, I think they have a better grasp on than other numbers. The employment numbers, I would call them suspect. On a monthly basis, right? That's why, again, look at the trend, not at the monthly number.
Yeah.
But, it just seems like there's some substantial misses that to get missed to the other direction the next month. So.
Well, the point of my question is, how do you get surprised? And the point of that is, there's so much information out there, so much talk. I mean, here we are taking stock every 2 weeks and looking at it and sharing information. And then I don't know what all the sources are. You have a lot of sources that you use to gather good information to help guide, the investments and things that you're involved with for your clients and everything else. So with all of that information available today, and all of the technology that makes it available, at the snap of a finger, that's kind of the point of the question. How do you get surprised?
See, I think, and you use the word good information. Right? So,
there's the answer.
But again, that's the exact reason why I look at things in the aggregate. That's the reason I look at things in the long term. I mean, let's take the financial sector. The financial sector is supposed to report a certain amount of earnings this quarter, right? But if you try and take one stock, let's say you take Bank of America, and Bank of America is supposed to report whatever it is, 75 cents.
Okay.
Well, Bank of America misses. They report 70 cents, or they do great. They report 80 cents. That's the one stock. But what I have found that if you take all 80-something, 90 stocks that are in the financial sector of the S&P 500, your probability of making good predictions of what's going to happen rises substantially because you're looking at the aggregate of 80 or 90 different companies, not just one company. So that's why, when we do our portfolios and things, we'll make a global decision. Do we want to be in stocks? Do we want to be in bonds? Do we want to be U.S.? Do we want to be international? But, if we're trying to decide, I don't want to go and buy 4 financial stocks. If I like the financial sector, I'm just going to buy the whole financial sector because my ability to predict what's going to happen there, I think, it has a much higher probability.
And that goes back to that with all the information available.
Yeah, right.
Notice I left the word good out.
You did, yeah. I mean, good. What's the definition of good, right? I mean, information becomes more reliable the longer the time period you look at, in my opinion.
Well, here's a curiosity just because of your experience with it for, closing in on those 40 years. You got my attention when you pulled out that's the key, good information. Well, now I have another question. How is there bad information, and then what's the ramifications? I mean, misleading the public. That's what I'm thinking.
Okay.
Misleading the public with what turns out to be bad information that can impact, the rise and fall of your company or whatever. I mean, what governs that, or how does that work so that somebody's not out there, like for the whole quarter they're saying did, or for the whole year or the month, whatever it is, and then the real information, which is ultimately the good information,
right, is
bad.
Yeah, so I'm going to give. When I say them, the question is who's them, right? But let's say the people who are doing the reporting. I want to give them the benefit of the doubt that they're trying. Okay. I think some numbers are easier to determine than others. I think inflation numbers are probably easier to determine than maybe unemployment numbers on a weekly or monthly basis and things like that. But where I start to, kind of the hair stands up on the back of my neck a little bit, and I start to wonder. Right? It's more. It's like when information leaks out.
I got you.
You know what I mean? So, like, all of a sudden, there's a report supposed to come out at 8:30, and all of a sudden it leaked out at 8 o'clock. Okay, well, where'd that come from? How did that happen? That's kind of, and we can have all kinds of conspiracy theories about, how that plays into, maybe in an election or something like that, But, and, who's the power? Again, that's a whole nother episode. But, again, if I'm trying to, if I have clients that say, I don't even know why we do this because everybody's cheating. Well, the reason we do it is because I'll look at that from a long-term perspective, and I think we can make a reasonable determination of where we should be and how we're going to do and things like that. So, again, I'm not going to worry about what this month's report is specifically, unless it's just a complete, absolute, ugly miss. But I still, again, I know I say this repeatedly, but it's the long term. So even if someone is in there playing games, it's going to work itself out. So
Okay.
So there you go.
Well, and again, hey, it was my question. I mean, there was curiosity when you start talking good or bad, when you start talking about surprises and you talk about how do those happen, then, that raises some questions about, are people, or the good versus, and I don't mean like it was good news versus bad news, but good information versus that wasn't good information, that wasn't accurate information.
Yeah.
It raises those questions, so I appreciate your walking through that to help us understand, how that can happen,
Right.
and I appreciate that you give the the benefit of the doubt that those are the reporting they're trying to get it right.
I'm not intelligent enough or have enough information to make accusations. Let's put it that way. But I had the opportunity yesterday to talk to Tigers Incorporated up at Sycamore High School. I got they asked me questions about business in general and my company, and kind of how I look at the world a little bit. And one young lady asked an excellent question. So I've been doing this for 37 years, 38 years, whatever it is now, and getting close to 40. And she goes, in all this time you've been doing this, what has changed the most? And I thought that was an excellent question. And then my answer to her was the flow of information. So back in 1987 or 1991, generally you got information, and you didn't receive near as much information back then as you do today. I don't remember when the internet started, but it was definitely in its infancy stage. You weren't receiving information like we do today. And honestly, we are receiving substantially more information. But again, the question comes down to, is it good information? I think the information may have been slightly more reliable 30 years ago than
the question is, what's the source? Who's the source? Where did the information come from? So you make a good point, like talking about the internet was in its infancy. Well, as more and more people have become a part of the internet, there's more and more, so companies now have their websites, and they're reporting all kinds of things, so that's true of everything everywhere, and it has grown. So the flow of information is absolutely the answer to that question. A good, where's that young lady now? She should be sitting here doing this, because she's asking these questions.
I honestly, I didn't get her name, and that's a shame, but she asked a couple of great questions. I was like, all right, we got a player back there, so it was good. And I'll give them a plug. That Tigers Incorporated is a fantastic organization, a fantastic class at Loveland High School. They're doing some amazing things. I think the kids are getting a lot out of it. And I'll embarrass Mr. Moran just a little bit. He's one of the rock star teachers in Loveland, that's for sure. He's doing some great things with these kids, and he'll be unhappy if he hears this, but he deserves it. So
fair enough.
Yep.
I always say I have to talk to those guys, but that's a whole different story.
Yeah.
Again, another episode for a different show or something.
They've got some exciting things coming down the pike, so some opportunities to talk to them. So
I hear you.
Yeah, so that's good. So anyway, we've had some good economic reports. We got a big day coming tomorrow. That will help, I think, determine where we're going to go. It's amazing. We sat here 9 months ago and did some predictions and things like that.
Yeah.
Well, here we are. We're coming around the corner. We're on turn 4. And it's going to be almost time to do it again.
You're just 2 weeks away from the 10th month.
Yeah, exactly.
So the final quarter.
But I would still say we have not gone into a recession. Here we are, and we've been talking about a recession easily since the end of 2021, going into 2022, easily, and that has not materialized. The inflation numbers have come down substantially. Employment's looking good. The consumer has, I keep saying it, the consumer's in it to win it, and and hopefully, we get our quarter point, or maybe we get a half point tomorrow. But that gets us this meandering market that we're talking about, maybe that gives us a little direction going forward. So that would be nice, because these markets where the market drops 5 to 8% for no good reason, those are aggravating days, honestly.
Well, there's no question. I mean, it shows, you can hear it from Art here on the show when those aggravating days happen. The ridiculousness.
That's right.
The ridiculousness of the meandering market.
Unnecessary strife is what it is.
I'm with you.
Yeah,
I'm with you. We don't need it.
Yeah.
Well, I'm one of those investors that you like, because I'm not paying attention
Don't pay
to
attention.
it.
Well, you're paying attention now, buddy.
Not until I have. Well, I pay attention here. Yeah. I hope so. Because I learn a lot, but I'm still trying to, keep that. It's a separation of church and state. So my personal investing, I don't want to look that close.
Gotcha.
When we're doing an episode of Taking Stock, let's take a good close look. Yeah. Let's take stock of what's happening. Which, by the way, what's happening right now in Taking Stock is we're coming up on the end of this episode. You had a lot going on, and to try and cram it into those 30 minutes. So you still got about 3 minutes.
Yeah. Well.
What have we not talked about that was supposed to be part of this show today?
Well, something else has happened here in the last few weeks. We have had what's known as an inverted yield curve for the last, year or so. And typically what that means is, if you're looking at the longer end of interest rate curve, looking at a typical curve is you would get less return or less interest on the shorter end of the curve and higher interest on the longer end. So, I'll get whatever it is, say 5% on my 3-month Treasury bills, but I should get 6% on my 30-year Treasury bond. So, but that has been inverted, where the shorter end of the curve, you've actually been getting better interest rates than you've been getting on, and it's been that way for, again,
on the 3-month or the 6-month or whatever.
Yeah. Typically, what that means is it's a very high percentage of the time when you have that means a recession is around the corner. So people have been playing this recession card for quite some time now, and it's been reflected in the yield curve. Well, guess what? Just here in the last couple of weeks or so, the yield curve has gone back to a normal curve. So you get less return on the short end, you get a little more return on the long end. So
you get to say, once again, the recession hasn't happened.
Didn't happen, but now, theoretically, the yield curve is saying it's not going to happen anytime soon. So I find that very interesting, that we've spent all this time worrying about a recession and all the strife that causes and the volatility that causes. It never happened, and now here we are. We're talking about starting to lower some interest rates, and the yield curve is back to what is considered normal.
So you were watching very closely, without even talking to me about it or our listeners about the fact that we had this inverted yield curve happening. That is like, a little, at least a yellow flashing light. Maybe there is a recession on the horizon, but it's returned to its normal yield curve, and so lights not flashing with green.
Yeah, we're green. I'll agree with that. I had to think about it for a second, but we're green. I mean, again, that's why you don't look at one single thing to try and make a determination, right? I don't make investment, solely on what the yield curve looks like. I mean, that is part of the equation. What are interest rates, and where are you, and where are we? I think we're going to be the next 12 to 18 months, all that good stuff. But again, we talked about this numerous times. The rhetoric did not match the numbers. The rhetoric was so very negative. Every time President Biden came on at one point, or Fed Chairman Powell, more so, it was the sky's falling. Right? I'm gonna get rid of inflation, but I'm gonna drive the market into a recession if I have to. That was the discussion. That never materialized, and here we are. We've gone from 9 or 10% inflation down to 2.6, I think, is the new number. So we're actually in the twos now, not only with the Fed's favorite number, the personal consumption expenditure indicator. But even if you look at the
PCE is all you and I refer to it.
That's right.
PCE.
Well, I want everybody to get their money's worth. But and, it's like, but even the CPI now is down below 3%. Yeah. So we've accomplished at this moment in time.
So PCE and CPI are both below 3%.
They're both. Everything's below 3%. Yeah, yeah, we're below 3% now. So, and
the inflationary reports are all, good.
Mm-hmm.
I mean, because they're lower. I always have to say this, and I just told somebody this the other day. I said, if you listen to Taking Stock, you're going to hear me remind everybody that despite the fact that the inflation is, below 3, it's still an inflation number. It got all the way, it got near to 10. It was above 9. Mm-hmm. The prices have jacked up, and I heard it this morning. What somebody just paid for lunch for an individual.
Yeah.
When did we have to pay $70 for a person for lunch? That's pretty good.
That must be a nice place because I don't eat there.
Yeah, well, but still, even and I know where he's talking about. I'm not going to bring it up, but wow.
Yeah.
That was inflation that happened. So my point is this: we're down below 3%, but that still is an indication of how the prices are still rising. What's inflating by only 2.6% is still inflating.
Right. Most definitely.
And that $12 cheeseburger, which we started this, 34 episodes ago, 68 weeks ago.
Right.
We started this. And we began talking very quickly after we started about the $10 hamburger. Well, I'm telling you, it's the $12 burger now.
Well, it was a $6 or $7 hamburger before that. So
right,
and that's not some bad things have to happen in order for those numbers to start working their way down. And it's like, okay, I want a cheaper cheeseburger, but do you really want a cheaper cheeseburger? So and a lot of things are carried over. We've got higher employment costs now. Instead of legislating it, it just kind of happened because of COVID and trying to get people to work and trying to get people back in the workforce. Well, if someone was working in a fast food restaurant, they wanted $15 an hour. We're like, there's no way, But guess what? They're making $15 an hour. But guess what? We're also paying. If a couple goes to a fast food restaurant, they're now spending $20.
Well, they're working. Now if you're getting $15 an hour, you're working an hour for a hamburger.
There you go. Yeah. Precisely.
Anyway.
Yeah, so that's, you don't, careful what, I guess my parting shot is be careful what you wish for.
Absolutely.
Well,
you and I, as we wrap up episode 34, we'll talk again tomorrow in episode 34B.
Mm-hmm. Yeah, exactly.
But, the addendum, let's see what the heck the interest rate drops a quarter, or does it drop 0.5%? That's the question. And that's where we'll leave episode 34. That's the question.
All right. Well, we shall answer that question mañana.
Mañana.
Yes.
En español. Tomorrow, for those of you who aren't in with this. But anyway, Art, thank you.
Yeah. Always a great time. Appreciate you.
Well, and it's always a great time. And the proof is in the pudding. It always takes us longer than 30 minutes.
Yeah. Well, we got some things to talk about.
Time flies when you're having fun.
Time flies.
I hope the listeners are having fun listening in. And anyway, mañana.
Yeah. Thanks, Chuck.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.